Okay, well, welcome again, friends. Thanks again for joining this afternoon or morning, depending on where you're tuning in from, to a great program as we discuss a great conversation surrounding navigating the recently signed into law tax bill or the One Big Beautiful Bill. This is an IFM member exclusive webinar. It is being recorded, so if for some reason you have to jump off, you can find the recording on the community website after the webinar concludes. One other important announcement, if you do have questions throughout the webinar, please feel free to post them in the chat box. We'll try to get to them either during the conversation or at the end. And with that, we can get started, and I will turn it over to Michael.
Haider, thank you so much, and good afternoon, and thank you everyone for joining today. And thank you, of course, to the IFA for allowing us to sponsor this webinar on franchising impact, navigating the one big beautiful tax bill. So today we're going to be doing a fireside chat, and it will be moderated by Haider, who you just heard from. He's the Senior Director of Federal Government Relations at the IFA. From the Citrin Cooperman team, you have Aaron Chaitovsky. He's the franchise practice founder. Andy Tarquinio, he's a tax partner in our national tax practice. We have Stephen Hurok, he's a tax specialist in our franchise group. And I am Michael Iannuzzi, I am the franchise practice leader here at Citrin Cooperman. So before we continue, I just need to pop up this one disclaimer slide. I don't expect everybody to read it right now, but it is very important because everything that we're going to discuss really is very technical and there's a lot of facts and circumstances that impact you personally and your business personally. So please speak with your advisor before applying anything that you hear today. All right, Aaron, I'll pass it to you real quick.
Sure. Thank you, Mike, and welcome everybody. As Mike mentioned, we are talking about the One Big Beautiful Tax Bill. It's 870 pages, over 100 topics, and the real gist of this tax bill is in the details. People are throwing away names and topics, but really you have to go into the details, how it applies to you, and there's so many interlooping items in this bill that it's really important to make sure you're dealing with the right people. We are going to focus on a handful of topics. These are ones that the IFA has been promoting and working with and has had some tremendous impact on how these ended up in the bill. So those are the main topics. But as Mike said before, it's very technical. We're hoping to take the technical part out of it and make it plain English for you. Mike?
All right. So these are the 6 topics that we decided to focus on today. So it's the 199A deduction. We have the estate tax, bonus depreciation, business interest deduction, no tax on certain tips. Notice how I said certain, and also no tax on certain overtime. So those are the big topics we'll discuss today. I'm actually going to pull the PowerPoint down for now because we don't want to just give slides to everybody. This way we can all be on screen, and then I will pass it on to here.
Thanks, Mike. Appreciate it. And again, thank you for everybody for joining the panel. Aaron, as you mentioned before, the bill had so many different aspects to it. It's such a huge bill, includes so many different things. A lot of the provisions on the business front were expiring end of this year. So could you just talk briefly about how the bill would impact the taxpayer, individual, or business owner?
So yeah, Aaron, I'll jump into that one, Hater. So I think
Oh,
the first
sorry.
thing that
Yes,
that's
please.
okay. The first thing that we'll cover before we get into some of the technical stuff is what some of the terms mean, because you're going to hear everybody today talk about things like sunsetting and what permanent means. So I'll give some definitions and then we'll move on to the technical questions. So the term sunset means any benefit from the original tax bill that will probably go away, this year or next year, which was creating difficulty in projecting or budgeting for people looking to expand their business, grow new units, estate and succession planning. The term, and I'm going to quote this, permanent, is a term that gives taxpayers some assurance that these changes will be around for a while, but they could change in a future bill or when the administration changes over in a couple of years. So even though they say permanent, it doesn't always mean it lasts forever. But for the meantime, we should feel optimistic that benefits like the 199A deduction, depreciation, and the estate tax exemption are here for now, and you'll hear about more of those later. There are also some new benefits, such as no tax on certain tips, no tax on overtime, and the increased SALT deduction. So in summary, these are some key terms, but make sure you're paying attention to what your tax advisor says, as you'll have to go through your individual scenario with your tax advisor. Thanks, Hader.
Thanks, Mike. And, the 199A deduction or the pass-through 20% was a top priority for IFA because over 90% of franchisees are set up as pass-throughs, and over 73% of franchisors are set up as pass-throughs. And so, Andy, could you just talk us through how that benefit works?
Sure, Haider, thank you. So let's take a look at Section 199A, which is the section for qualified business income deductions. This section was originally enacted as part of TCJA, which stands for the Tax Cuts and Jobs Act of 2017. It was designed to give owners of pass-through entities a reduction in their tax rates similar, but not exact, to the reduction in tax rates received by C corporations. One interesting note about Section 199A, IFA, Aaron, and I were in Washington, D.C. speaking with senators and the Joint Committee on Taxation as this proposal was being considered in the fall of 2017. And fortunately, we were able to offer our insights on the framing and what eventually became Section 199A and how best to implement it. So no one knows better than the Citrin Cooperman how important this section is to business owners, including the franchise industry. Essentially, the qualified business income deduction provides owners of pass-through entities with a 20% reduction in their effective tax rate on qualified business income. So if your qualifying business income, which does not include wages, does not include interest, dividends, or capital gains, was $100, you would only be taxed on $80. Prior to TCJA, C corporations had an effective tax rate of 35%. If the C corporation chose to distribute its net earnings after the payment of federal taxes to its shareholders, the combined corporate and individual rate 50%. With the enactment of TCJA, C corporations now have a 21% effective tax rate and a combined corporate and individual tax rate of 40%. So keeping these two percentages in mind, 21% and 40% on a combined basis, let's take a look at the parity that Congress tried to provide the reduction in corporate tax rates and individual tax rates and see whether or not they accomplished that. Prior to TCJA, individuals had an effective tax rate, meaning their highest tax rate of 37%. With the enactment of TCJA, individuals can receive up to a 20% reduction in their effective tax rate on qualifying business income, which provides their overall effective tax rate from 37% down to 30%. This individual tax rate is higher than the C Corp rate of 21%, but lower than the combined C Corp and individual tax rate of 40%. So from a planning standpoint, if you have a pass-through entity that's only making minimal distributions to donors, you are constantly reinvesting your earnings into the business, you might want to consider being a C Corp. However, if you like most pass-through entities where you distribute most of your earnings, pass-through entity is still the place to be. There are nuances and limitations in applying Section 199A. For example, this 20% deduction is limited to the lesser of 20% of qualified business income or taxable income on the individual's tax return. And for those taxpayers that have taxable income above certain thresholds, 190K for individuals and 385K for married filing joint, this 20% deduction is limited to the greater of 50% of wages or 25% of W-2 wages plus 2.5% of your historical cost of your fixed assets. Pretty much exactly what Aaron said at the beginning, the devil is in the details. Under TCJA, the Section 199 deduction was set to expire at the end of this year. Under the One Big Beautiful Bill Act, I'll refer to it as the Act moving forward, changes to Section 199A were broadened and made permanent, providing greater stability for pass-through entity planning. At Citrin Cooperman, we refer to the passing of this act as the summer of opportunity, which translates into being a great time to start your planning for 25 and 26, a theme that will be expressed in this presentation. With that said, over to you, Aaron.
Yeah, and I apologize to everyone. Andy, unfortunately, some of your discussion was cutting in and out. But just to recap, what Andy was referring to is obviously the 199 Cap A, this pass through, gives you an opportunity to exclude if you qualify, if you're a qualified small business, it gives you an opportunity to a qualified business, an opportunity to exclude 20% of the income that you earn on your corporation, on your pass-through company, exclude it from paying any tax whatsoever. It was going away this year. Now the permanents put this back in, and it's as permanent as Mike said earlier until the next administration decides to make a change. So this is huge, and as Haider said, this is what the IFA was pushing like crazy. on these pass-through entities. The majority of our companies are pass-through entities, and that's what this is all about. But there's a lot of nuances there, whether certain specialized industries that can use it, consultants can't use it. It doesn't really work as well for a lot of the consultants, possibly the attorneys on this group. But there's opportunities here, and it's very important to look at your own particular situation to see if you could take advantage of this. And there's also time to do some planning before the end of the year to see where income is coming in. If there's a way to structure this, you could take advantage of this. Now, what Andy was discussing is something near and dear to all of us at the IFA, and that's pass-through entities. What seemed to get a lot of press as well was this concept of 1202 stock. And you may have heard that name bantered about. Basically, it's a corporation as opposed to a pass-through entity. And it's set up as 1202 stock. That means that if you set up this corporation and it's a qualified small business, doesn't work with a public company, it's a qualified small business, what they've done is there are opportunities when you sell the company to be able to exclude $15 million of your gain from tax. Now, the rule beforehand was only 10 million. Now you can exclude 15. Obviously, that raised a lot of eyebrows, and that's per shareholder. And that means also if you have a shareholder that opens a number of trusts, there may be a way to even do more than 15 per family group. Another thing they did with this 1202 that made it more impressive than it was before is they also gave you a phase-in period. In the past, you had to hold this stock for 5 years. Now, if you hold it for 3 years, 4 years, or 5 years, you can still exclude some of the gains that you have in the sale. Sounds wonderful. Very important to make sure you're a qualified small business, and there are a number of companies that were completely excluded from this. If you look at the details, there are a lot of restaurants and hospitality, obviously, which is a big portion of franchising, is excluded, as are certain other industries where all you do is consulting. But again, it's general. It needs somebody to really go through your particular company and see if you're considered a qualified small business. It's really something that I would assume is not that popular amongst franchising in general for franchisors. Franchisors, typically, when they start up, they have losses in the early years. If you're a C corporation, those losses may be buried in the corporation, meaning you can't take the benefit of those in your personal return. You may have situations where quite often what we've experienced, and we see a lot of sales of franchisors, a majority of the franchisor sales we see that would qualify as a small business have been asset sales. This only works if it's a C corp sale, somebody actually buys the stock of your corporation. And when you think about it, if you're building a company or building a franchisor with the intent to sell down the road, by knowing the only way you could really benefit from the fact that you were a C corp and own this 1202 stock is if you sell only if somebody buys the corporation, you limit the number of potential customers you might have down the road when you sell the company. There are also limitations as far as total assets in the company, what's considered a small business. It's something to consider. It's something that you've heard about. Everyone's running thinking that this is the best thing was ever created. And basically this tax bill just increased the potential benefits of it. But I think for most of us, it's not necessarily something that's going to really be beneficial if you're a franchisor. But again, that's generally, speak to your advisors. There are ways to possibly work things out where you can take some benefit of this, even a small piece of your business. It may make sense to work with this. But in general, that's what 1202 stocks, if you hear the name bantered about, that's what it's all about, being a C Corp. But again, you're going to lose all those pass-through benefits, the 20% tax-free income along the way. You're going to lose out on those types of things that are afforded to pass-through entities, including being able to pull money out of the company along the way as this profits in the company. So consider it, see what works best for yourselves. If you have questions, obviously speak to your advisor. It's complicated. It's complicated whether you're considered a qualified small business, but it's something that you shouldn't ignore when you do your planning, and sit down with your management as to what the management's plan is and really work this out. There are a lot of numbers here to work through to see if it actually makes sense to even become a C corporation. Thank you. Back to you, Haider.
Thank you, Aaron. That's very helpful. I will say This is an off-the-record conversation for IFA members only. So if you are part of the press, you may want to leave the call now. I should have mentioned that 15 minutes ago. And 3 people left. I'm just kidding. But let me just switch up the topics. And Steve, I'd like to bring you into the conversation. So the estate tax exemption. Could you just tell us a little bit about, I know Aaron touched upon it a little bit, but what is that and how can the folks online take advantage of that?
Okay, thank you. Yeah, what estates are taxable and gifts can be taxable, but Congress has provided an exemption so you don't have to pay tax for smaller estates or smaller gifts. And the reason I mention gifts connection with the estate is that both gifts and transfers at death are taxed in the same way. It's like a cumulative tax. You have to keep track of your gifts as well as your assets when you die. But years ago, they increased the exemption amount for death purposes and gift purposes to a rate of $5 million. That's been adjusted for inflation. So that in the current year that we're in 2025, the exemption is almost $14 million as we speak. But what the law did is that starting in 2026, there was a risk that the exemption would go back down from what had been increased for a number of years. And that was of concern for a lot of estate planners. So they've solved that problem in a way by making the exemption in 2026 $15 million for each taxpayer. So a husband and wife potentially has $30 million. Now, most people say, I'm not going to have an estate that big. I don't have to worry about it. But in a way you do for the following important takeaway reason. If the first spouse dies, it has, say, a small estate. I'll just arbitrarily say, to use a number of $5 million, and it's below the exemption amount, there's no estate tax. If there was an estate tax, if it goes over the exemption, the rate is 40%. But if there's no tax, there's no tax. So many people don't even file an estate tax return because it's $5 million. Well, that's typically a mistake. Why it's a mistake is that the concept of portability, which means like transferability. So when the first spouse dies, let's assume we're dealing in 2026 even, and the exemption's 15 million, and first spouse is a $5 million estate, there's $10 million of the exemption that's not being used. Well, there's an election that applies only when the first spouse dies to elect to transfer that $10 million of unused exemption to the second spouse. So when the second spouse dies, there's 15 million for the second spouse, plus the transfer of 10. So the second spouse can use $25 million. And the reason that's relevant, in my view, is that although the first spouse had a small estate, who knows what the life expectancy is? Who knows what the compounding value of your business will be? And sure enough, it could increase as you hope it would, so that when the second spouse dies, there very well could be an estate tax issue. And so omitting the election to use the unused exemption for the first spouse is very important. Now, for strange reasons that no one quite knows, they didn't make it automatic. So if you don't use it, it automatically transfers to the second spouse. It requires an election on the first spouse estate tax return. So if you don't file an estate tax return, you end up with a problem. Well, there's a couple fixes that are out there for people that forget to do it, but even those solutions are time bound. So if you wait too long and you missed it, you may lose it forever. So that's something to think about. And, in a unique situation where you're a surviving spouse and the first spouse didn't use the exemption. So that's kind of a takeaway for the future. The other important takeaway I just thought I'd mention is the key point when you're dealing with estates and transfers and gifts is valuation, especially when you're dealing with intangibles, something that's you can't touch and transfer yourself, but it's the value of the name, the value of the business name, which is considered an intangible. You can't touch it and move it, but it's obviously something that's valuable. And those intangibles are very difficult to value, particularly, land you can value with a couple of reference points, but intangibles are pretty unique. And therefore, when you're transferring them, it's very important to get a proper valuation so that the IRS can't later challenge that transfer that you did. So the two takeaways I will offer is the portability election. You want to be careful you take care of that, and of course, valuation. So those are the 2 points that I wanted to be sure I'd emphasize. The $15 million will be adjusted for inflation starting in years after 2026. And then, of course, you know, as Michael said in the beginning, it's a permanent change. There isn't any plan that the $15 million plus inflation will drop, but of course, Congress could always change the law. So that's what I wanted to be sure to convey to the group. And Haider, I think it's back to you.
Thanks, Steve. Mike, any additional thoughts?
Yeah, sure. Yeah. And Steve, thank you for that summary and thanks, Haider. So, I mean, look, this was a great win, as Steve has mentioned. And as all of us know, we're all in franchising, and franchising has been around for, many decades, and it's becoming more and more popular. Gifting of stock to family members and others is a major part of dealing with all of our generational wealth that people are creating. Very often, the value is in the estate. It's not sitting in liquid cash. But as Steve mentioned, it is the value of the brand name and those intangible assets. For the franchisors and franchisees out there, now is the time to revisit your succession plan. And whether you have a plan in place or not, start meeting with your tax attorneys, tax advisors, estate planning people, because now is the time to start planning for this. Don't miss the elections that Steve mentioned, because these things are very hard to retroactive go back once the elections are missed.
That's great. Thanks, Mike, and thank you, Steve, for those insights. Another part of the bill that IFA was heavily focused on was this 100% bonus depreciation or depreciation deduction issue, which not only were we hoping to get restored, but also get extended. So, Andy, I would like to come back to you and talk us through what's in the bill as it relates to bonus depreciation. And then if we can't hear you, turn over to Aaron possibly for any additional thoughts.
My apologies to the group. I've been having difficulty with Teams, and I thought coming off screen would make a difference. We'll see what happens. So let's take a look at bonus depreciation. Bonus depreciation became available for both new and used property under TCJA. Started out with 100% bonus depreciation for property placed in service, the annual percentage of bonus depreciation by about 20% a year through 2025. Under the new act, 100% bonus depreciation was made permanent for qualifying property placed in service January 19, 2020. Bonus depreciation is automatic. If you don't want to take bonus depreciation, you need to formally elect out a bonus depreciation by making an election on a timely filed pass-through entity tax return. More to come on this. The application to new and used property to bonus depreciation remains the same. Key business implications of bonus depreciation include improved after-tax cash flow, simplified capital planning due to the permanence. Cost segregation studies are also very valuable in this area. Let's talk about state tax conformity. Each state has its own rules with respect to the adoption of federal changes in tax law. Most states do not adopt the federal bonus depreciation regime, and this can represent a very big trap for the unwary. For example, let's take a hotel that places $60 million in 5 fixed assets and takes 100% bonus depreciation. Let's further assume that this entity's federal taxable income after bonus depreciation is zero. Now let's take a look at a state like New York that has a bonus depreciation add back. So for federal tax purposes, the owner's individual taxable income is zero. The state, you start out with federal of zero, then add back $60
Andy,
million
our listeners are having
in bonus
a hard
depreciation.
time. Our listeners are having a hard time hearing you. So if you don't mind, we'll go to Aaron for any thoughts.
Maybe what I can do is call in on my cell phone, just go to the next topic, and I'll come.
No, that sounds great. Thank you, Andy.
Yeah, Andy, yeah.
Conversation.
I'll come back. All right.
Right, let me
Can you send me the call-in number if I can't find it in the invite?
Yes, we'll send it to you.
Go ahead, Aaron.
Yeah, just recap, obviously bonus depreciation, exactly what that is. It is automatic. Be careful with that, but it's bonus depreciation where you're able to take on the qualified items. Obviously, it's assets purchased in 2025 going forward. And it's a situation where it sounds wonderful taking all this bonus depreciation. You got a big deduction, but you've got to really do some analysis before you take this available bonus depreciation. It sounds great to say I bought a $100,000 piece of equipment. I can write it off this year. That's wonderful. What ends up happening is you enjoy the benefits this year because you took the $100,000 deduction. But let's say you finance this piece of equipment. Next year, you're going to be pay the finance payments next year. Those actual payments against principal are not deductible. So all of a sudden next year, you're going to have a big tax potentially because you don't have the deduction. And sometimes it makes sense to spread out the depreciation over the same term that you're paying down the debt. Again, it's a calculation you may want to do. That may be beneficial. The one key area Andy was stressing, which is really critical, is this is a federal bonus depreciation, not a state depreciation. So you may have your tax return for federal purposes. You buy a $100,000 piece of equipment, you take $100,000 of expense deduction, you show zero income because you wiped out your income with depreciation. Now you're going to file your state return, and you've got to add back all that bonus depreciation you took and just take the depreciation that's allowed state by state. And as we know, a majority of our franchisors, as well as our franchisees, operate in numerous states, and each state has their own rules as to what method is allowed. So it's very important to actually sit with your advisor. You don't want to jump and say bonus depreciation is wonderful. Okay. It does another thing. Bonus depreciation creates a larger gain on your sale because your assets are lower, your net assets, so you may have to pay a higher tax. And the way it works with bonus depreciation is when you sell assets that you've taken some accelerated depreciation, there's a term called recapture, and which means that if I've taken excess depreciation on an item, when I sell that item, I may have to pay ordinary income based on how much depreciation I took, ordinary income tax, as opposed to capital gain. So it gets a little more confusing as you sell businesses. It also has an effect on your basis as well. So there's a number of items, like we said earlier, moving parts here that definitely have an effect on it. It's wonderful that it's permanent. And the one other area that I would definitely recommend everybody do, you may have heard the phrase cost segregation studies. Cost segregation studies right now are probably more important than they've ever been before. Cost segregation studies are companies that come in, they analyze everything, let's say in a particular building you have, leasehold improvements and things like that, and they justify why some items are considered smaller tangible depreciable items, because that would make it qualify for this bonus depreciation. So a lot of moving parts, as Mike said before, and as we keep repeating, getting your advisor involved is very important. And even before you wrap things up, before the end of the year, now's the time. You really have to speak to them now. There are a lot of things to do with the 199A before the end of the year, potentially making determinations if 1202 worked for you. The depreciation is very important to figure out what you want to do with that right now. And I think that a lot of this all ties in to that estate change as well. All of this ties together. You really should be speaking to someone who understands some of these nuances and really focuses on what the details say to this.
Aaron, if I could, I'd like to add maybe two
Sure.
points to this discussion.
Please.
One is if the bonus depreciation is very large as you're doing your expansion and you think that's going to be great, and it creates even losses to wipe out your income, it might even create what we call net operating losses, where the deductions exceed the income. And although net operating losses can be used in the future, under the current rules, you can only use 80% of it. So by taking too much bonus depreciation, you're limiting the deduction in the future to 80% of the next year's income. Whereas if you plan out the bonus depreciation, you might be better off. So that's something to keep in mind. And the other point is that it's not all or nothing. You can elect bonus depreciation by different classes of property. So you can use, if you will, a sharper edge to claiming it as opposed to doing it wholesale. That's it.
Excellent points. Thank you.
That's great, Steve. I was actually going to come back to you for our next topic, and that is the business interest expense. Another issue that IFA was sort of leading. We'd love
Right.
to hear more on your thoughts on what's included in the bill as regards to that, and how can folks, take advantage of it.
Yeah, for a number of years, there's been a limitation on business interest expense. And under current law, you have to compute not just taxable income, but your income before the deduction for interest and before the deduction for taxes. That abbreviation is sometimes called EBIT, EBIT. Previously, when the law was first enacted many years ago, the concept was you limited the interest to 30% of your EBITDA, which is interest, before taxes, before depreciation, and before amortization. So depreciation and amortization can be pretty big numbers. And if you don't take them into account, you add them back to your base, which is called adjusted taxable income. And by increasing the base, you then apply the 30% limitation to the increased base. So because your base has been increased by depreciation and amortization deductions, you can deduct a larger amount. Now, that's going to be in effect for our current year, 2025. So that's a current year, not 24, but for 25, you can deduct a larger amount. Once again, as we mentioned in connection with bonus depreciation, not every state follows that rule. So you have to be careful of the state variations. And just as a general concept in talking about states, the federal rate, relatively speaking, 2 years ago, is on the more modest side. The individual rates have not gone down at all as a general rule. And so state taxation as a percentage of your overall burden is increasing. So in addressing these issues, the federal rules that are somewhat more liberal are very nice, but you have to be careful of the potentially adverse state impact. Now, if you're a smaller business, such as under 31 million in revenue, to be specific, then there's a small business exception, and this limitation shouldn't be applicable. Now, if it is applicable, however, and you do have a limitation on the interest expense, what do you do with it? Well, it's a separate carryover. You can't deduct it in, say, 2025. You have more interest in excess of the 30% of EBITDA limitation. You can carry it over to future years as if you paid the interest in the following year. It doesn't go into the net operating loss carryover calculation. It's a separate carryover because it's subject to the interest limitation in succeeding years. So that's kind of a brief summary of the expansion of deductibility of business interest.
Thank you, Steve. Mike, any additional thoughts there?
Yeah, I like to do this little like color commentary that I add 1 or 2 sentences because I'm not a tax guy, but I do play one on TV. So many, so on the franchising side, many of the, franchisors, especially the larger multi-unit franchisees that are, constructing facilities, purchasing machinery and equipment, they may be in a scenario where they have to capitalize some of this interest because they're using debt to finance all this expansion. This capitalized interest, it does go back into the pool of interest that you're looking to deduct, but these calculations are complex. So just make sure you're, planning for this when you're doing your projections, when you're doing your, future build outs, when you're doing units 3, 4, 5, if you want to do a multi-year projection on this way, what benefit you're getting and what benefit may be carrying over.
Just, if I could just add one thing also on the interest, when you think of the example, let's say I have $100,000 of interest this year, and my EBITDA was let's say it was $90,000. So I get 30%. My interest expense for this year is limited to 30% of the EBITDA, 30% of the $90,000. The rest, as Steve mentioned, gets carried over to next year. When I get to next year, keep in mind that year is going to have its own interest to add to this interest. So I may be carrying interest year after year after year, not being able to take it because all of that interest gets lumped together to see what percentage I'm going to hit with my 30%. So it's very important to plan this out, where you stand to be able to get the best benefit of this interest expense you pay to run a business, especially if you're building businesses, building, constructing things, as Mike said, the number could get very large carried forward, and you end up with this very large carried forward interest expense until the law changes somewhere down the road and has more limitations. We're not sure where that's going.
Great,
I'm
thanks
sorry, back to you, Haider.
No, appreciate it. So, we talked about no tax on tips and overtime, and this was obviously a big priority for the administration this year, and that's why it was included in the bill. Steve, what does that mean to the average franchise owner, and how is it calculated?
Well, as usual, the headline says one thing and the details say something else. So the headline is no tax on tips. That's not really what the law is. The law has been changed starting in 2025, is that if it's a qualified tip, and let me come back to that word qualified tip. If it's a qualified tip, you're allowed on a joint return a $25,000 deduction against those qualified tips. But anytime you hear the word qualified, that means watch out for the details below, because it can mean a lot of different things, and it's like an overused word in the world of taxation. Qualified this, qualified that, which means keep on reading. And qualified tips refers to those that are customary and regular. Now, what are customary and regular? The IRS has been charged with completing guidance on this by the end of October, I believe. And so they're going to be deciding which tips are customary and regular. So that suggests that if a business line or a business service provider gets an occasional tip and doesn't get it regularly, that might not be a qualified tip. One of the other meanings of qualified, it needs to be voluntary. So the problem is, say, particularly in restaurants, where they automatically say for a party of 6, charge 18% or whatever their number is. That's not voluntary. That's a negotiated, that's a determined rate, and that's going to be considered a service fee and will not be considered a qualified tip. There's also certain businesses that will not be eligible. Their employees will not be eligible for qualified tips. And those are typically businesses that are generally higher income. Those are some of the requirements for a qualified tip. Also, this provision is only going to be in the law for 4 years, 25, 26, 27, and 28, and then it goes poof. So that's another potential problem. The other point is, to be a qualified tip, it needs to be reported on the Form W-2 of the employee. There's going to be a separate box for presumably qualified tips. And that is going to be subject to Social Security tax for both the employer and the employee. And so, and that's a requirement to be a qualified tip. So in order to get a qualified tip, it's going to be reported on your W-2. Maybe you'll get the offset deduction, if it's under 25,000 on a joint return. That's fine, but once it's being reportable for Social Security tax purposes, that's not going to stop in 2028. That's going to keep on going. So the reporting requirements are going to become difficult for employers, such as if you're operating a franchisee, you need to keep track of that information. You need to report it on the W-2. So your payroll service provider is going to get involved. It's not going to be easy to do. And as I say, there's some of the details as opposed to the headline, no tax on tips. Now that deduction, by the way, is going to be applicable whether you itemize or not. So that's another favorable aspect to it. Similarly, there's another deduction available for what is considered qualified overtime. Once again, qualified. So it's not just any overtime, it has to be relatively specific based on the labor law. Similar to tips, also there's a high income phase out. So once on a joint return, your income is over $300,000. For every $1,000 in excess of that, you're going to lose $100 of the qualified tip deduction and the qualified overtime deduction. So there's going to be increased reporting obligations to report these categories of income. And it only is, similarly to tips, only a 4-year rule, 25, 26, 27, and 28. Thank you.
So, Steve, if I could just add to that, as Steve mentioned, the headlines look great. No tax on tips, no tax on overtime. There's so many nuances with this. Most companies, most restaurants right now are putting an automatic service charge in there, which automatically makes that now taxable to the employee as regular income because it's a service charge, not voluntary. What's considered voluntary and customary? Look, for all of you that may have purchased homes recently and you're sitting there at closing and your attorney says, oh, don't forget you have to tip the title clerk that's there, which is kind of like a standard thing. Is that really voluntary? Does the title company pick that up? Is that considered a voluntary tip? Also, very often tips are pooled and it goes to some back office people. It may go to the chef. It may go to others behind the scenes. Is that considered? Do they customarily get tips? So there's a lot of nuances with this. It's just a taste of no tax on tips and no tax on overtime. But understand it is something you've got to be very cautious of. It does give your employees a benefit if they can actually collect tips. But one of the pitfalls here, as Steve said, is now it has to be reported on your W-2 for the next 4 years. And my guess is in the 5th year, when it doesn't show up on a W-2, it could raise some eyebrows. So just a point out there, not giving advice, just mentioning that you are going to record with these, and it's something to abide by the law. You should be reporting it all, obviously, and it's something to just speak to your advisor, because it's a little more detailed than it came out to.
Thanks a lot,
Okay,
Aaron.
back to you.
So there's another issue that was very important to IFA members. It was the SALT and pass-through entity tax deductions. Andy, I see that you've rejoined us, and we're glad to have you back. If you can hear me, we'd love to pose that question to you and ask where we stand with that.
So I'm not sure it's going to work. So I signed back in on the same computer. So I apologize again for the group.
We hear you better.
All right, thank you. So first, let's take a look at the state and local tax deduction. Before TCJA, the SALT deduction was unlimited for individual taxpayers who itemized deductions. With TCJA, the SALT deduction for individuals was capped at $10,000 per year, $5,000 for married filing separate. Under the new act, the SALT deduction has been temporarily increased to $40,000 per year, $20,000 for married filing separately. This increase in the SALT cap is particularly beneficial to taxpayers who itemize and live in high state tax jurisdictions. There are new income limitations that exist under the SALT cap that did not exist before. The SALT cap phases out for income over $500,000 for single and joint filers, and $250,000 for married filing separate. After 2019, the SALT deduction cap is scheduled to revert back to the original $10,000 limit. Now let's take a look at the PTET deduction. It's important to note that the benefits associated with the $40,000 SALT cap are separate, distinct, and in addition to the benefits associated with the PTET regime. So far, so good?
Yep.
Okay. Almost immediately after passing of TCJA and the new SALT cap, states and local tax authorities started developing new strategies, workarounds for deducting state and local taxes on business income. After all, there was no limitation on deducting state taxes at the C Corp level. Why should there be at the pass-through entity level? These workarounds eventually became known as the pass-through entity tax. Apparently, the states got it right, as the SALT cap was never designed to limit state taxes to $10,000 on business income, only on non-business income. And on November 9, 2020, the IRS published a notice which gave some structure and guardrails for how this PTT regime would work. This notice stated that the IRS would issue regulations, but they never come, nor will they. The PTT tax regime is a hybrid system. For federal tax purposes, state taxes are deducted in arriving at federal income. For state and local income tax purposes, it's treated as an estimated tax payment. This hybrid system creates substantial uncertainty, especially in many areas, especially around state tax refunds. For example, assume an individual made estimated tax payments that were not deducted for federal tax purposes, and that individual overpaid their state income taxes. Is that refund included in taxable income in the next year? Not likely. But for PTT refunds, where the state taxes have already been deducted to a certain extent for federal taxable income, the answer could be different. Many practitioners, tax practitioners, have taken the position that some portion of PTET, state tax refunds, are taxable for federal tax purposes. Whether or not this is correct remains to be seen. There's nothing in the guidance that helps you to make this determination. And like many things in tax law, the determination is facts and circumstances based. To try to illustrate this very complicated topic, take the example of an individual has $1 million in PTET income and a tax credit for state purposes, PTET tax credit of $100,000. And they have other income of $500,000 with state tax estimates of $50,000. Further assume that although this income projected at $500,000 in other income, actual amounts of the return was zero, and the individual gets a state tax refund of $80,000. How much of this refund should be included in federal taxable income? Another example of the complexities in determining whether or not this refund would be included for federal taxable income. Further assume that this individual actually passed their earnings for $500,000, not $1 million. The PT credit remained the same at $100,000. And other income came in at $500,000 and no estimates were paid. And that the $100,000 of PTE tax credit was enough to satisfy this individual's state tax liability with no state tax refunds being due. In this instance, a portion of the PTET tax credit was used to satisfy a liability for non-PTET income. What happens? There's no rule of law that tells you what to do, but for the most part, people think that you don't have to pick up this refund. There's no guidance out there that explains what to do, which means that many tax advisors don't know what to do. At Citrin Cooperman, we study this issue extensively. You find yourself in this situation, please feel free to reach out to the IFA or members on this presentation team, as we have a lot of thoughts on how to implement this rule to your advantage. Over to you, Aaron.
Well, Steve, you have anything to add on this? You're on mute.
I think Andy covered it pretty well. I think the most important point is, even though the headlines have advertised an increase in state and local tax deduction, which is accurate, I think the more important point for pass-through entities is that the PTT, the pass-through entity tax, which is considered a tax on the pass-through entity for state and local taxes, is continued, has been continued. And for pass-throughs, you should be sure you do it. Now, often it's a little complicated because each state has its own rules and requirements to do it, to make the elections, the timing of the election, and how it should be paid and how it should be refunded. And for multi-state businesses, it pays to explore that option because it's still a very valuable benefit.
And if I could just add, Steve, absolutely right. The pass-through, as Haider had mentioned earlier, pass-through is a very strongly used vehicle for most of the members of the IFA, the franchisors and franchisees as well. And the wonderful thing about the PTT is it's not excluding those specialized industries like attorneys and accountants and individuals who are consultants. They qualify for this. What this is giving you an opportunity to be able to deduct your state taxes paid on your income through your corporations. And it's done because each state is now taxing the entity on your behalf. There are definitely, as Steve said, I'm sorry. Yeah, it's a tax on the entity.
S corporations. And
S corporation, and this pertains to S corporations, pass-through entities. It could be LLCs. It could be on Schedule Cs potentially. There are opportunities here to be able to take benefit of this. If you're not taking advantage of the PTT, then you're missing out. You should definitely speak to your advisor. The deadlines, as Steve mentioned, are critical. You've got to hit certain dates to be able to take advantage of this state by state potential extra deduction for state taxes paid. So that's something that should be looked at very, very carefully and make sure you take benefit of that. The crazy part is when everybody was looking one way at the fact that we're trying to raise the salt tax, everybody's looking for the salt, state and local taxes being deducted, bring it up to $40,000. The original version of the bill removed all the PTT benefit. And what was brought to the attention of the IFA started pushing very hard. I know the accountants were pushing very hard. AICPA was pushing hard as well. And this went back in there. This would have been devastating. You could have raised the SALT cap to $40,000, but for all the businesses out there and the individuals who own a share of a pass-through entity, the loss would have been huge for not being able to deduct all these taxes. So please, if you're not familiar with the term PTET, get on the phone with your accountant, get on the phone with your tax advisor and say, what is this? Does it apply to me? Why am I not using it? Why am I not taking advantage of this opportunity?
That's great. Well, thank you all for all these great insights. We obviously covered a lot of topics today. Mike, anything you want to add in terms of any takeaways from today's conversation or summary?
Sure, yeah. So I'll summarize the 4 or 5 topics that we spoke about. I'll give a key highlight to each. Before we do that, there's a couple of other random topics that are floating around that it looks like we will have a couple of extra minutes. So Aaron, before I go through and summarize the main stuff, do you want to touch on a couple of the topics that affect membership base here, but we didn't cover today?
Yeah, there's a couple of small ones, little nuances in the law that kind of slip through affecting individuals. One of them is charities. Okay, they decided to do something nice, and for those individuals that give charity, if you give up to $2,000, an individual can take a deduction on the return above the line, even if they take the standard deduction. They'll have $2,000 of charitable contributions on their tax return, which in the past, if you took the standard deduction for your individual return, you get no benefit for these types of expenses. And it sounds great, and it's a wonderful thing. It's a way of making sure more people take advantage of being able to give donations and get a deduction for it. And then the government, though, has to pay for this somehow. So the way they've paid for this is now, number one, for those people that give larger amounts of contributions and do itemize the deductions, 0.5% of your adjusted gross income, the contributions you give are only deductible if they exceed 0.5% of your income. So you take someone who earns $100,000, wants to give a donation and is able to itemize. Let's say I have $100,000 of adjusted gross income, and right now you're talking about on the $100,000, you've got $1,000. The first $500 of your contributions are not deductible at all. Okay. Now the crazier part is usually when you pay something and give a donation, it offsets the tax you have. So if I give a donation of $100, if my tax rate's 37.5%, I get a 37.5% benefit federal. Not the case. They're only giving you a 35% benefit. So you're losing a 2.5% tax benefit as well. So as your income grows to the higher adjusted gross incomes, you're going to find these limitations that are there. You're also limited to 60% of your adjusted gross income. And for those that are very charitable, it's a lot of money, but there are people out there definitely exceed their income. It gets carried over. And there's some crazy nuances with that as well. So the one thing I will tell you, it's now August. If you're doing any type of charitable giving, look at those rules to see how it's going to impact you. It may be better to give the donations next year versus this year, see where your income stands. And there's a lot of calculations that have to be worked out to see when it's beneficial to give these contributions. Obviously, you should give with your heart. But if you're looking to see from a tax planning strategy, this is very important to look at those things. Silly things they did. I'll just mention one more quick one, Mike. I know we have a lot of our conventions are at casinos. And why they had to attack this, I have no idea. But gambling. In the past, if you win $10,000 and you have $10,000 worth of losses gambling, you can offset them and there's zero tax. Well, what they've done now is you can only deduct 90% of your losses. So let's say you made $10,000 in the casino. And let's say you have got losses of $11,000. Well, of those 11, you can only use nine. If you made 10,000, you can only use $9,000 against the 10 that you won, which means now you're paying tax on money you don't even have. Okay, you've lost it in the casino, but they're still taxing you on 10% of your gains. They're not letting you offset. Nuances like this, like I said before, there's hundreds of items, hundreds of topics that are covered. Some are small, some hit the individuals. There is so much this bill. Everyone's focusing on those large topics, but the reality is there's so much in the details, and it's so important to speak to someone who has an understanding of what's in the bill and how it affects you personally and from a corporation. I'll leave it to you, Mike, because there are others as well, but I think we'll make sure we have enough time for recap. So, Mike, do you want to just recap where we are right now? Put the slide back up, I guess.
Yeah, let me pop that up. Oops. Yeah, so we'll go here through. So yeah, I'm gonna pop through some of the key takeaways, which summarizes everything that we spoke about today. And thank you all for spending this hour with us. The big one, a couple of big ones, but the first big one, the 199A deduction, as we discussed, if you and your company qualify, this is a federal tax benefit only, which will allow a 20% deduction on your income for federal tax purposes that are passing through to you personally. So as you're doing your projections, do not forget about the states that you're operating in, because this is a federal benefit. It may not carry over on the state side. There are a few states that follow this, but not many. So this is an important, planning tool. The estate exemption that we discussed earlier, and I'm going to quote again, this is going up to 15 million permanently, which is permanent for now, which may change in Congress, later on. The valuations here are key to this because you want to make sure you're holding up under IRS scrutiny later on in case this gets challenged. When you're doing certain gift tax returns, there are certain requirements to attach valuation. So please make sure that you're taking care of this and, electing the options that Steve mentioned earlier, so you're not missing any of the deadlines. Depreciation, this is also a great benefit that you heard earlier. Again, remember, we're always talking federal and state. So even though the federal gives you the benefit, certain states may not. So you may not have a federal tax bill, but you may have a state tax bill at the end of the year. So definitely factor that into your cash projections and your tax projections. The interest expense does allow for more deductibility and may potentially free up some of that carryover interest that was not deductible in prior years. But these are complicated calculations based on also the rules that Steve mentioned. So make sure you're planning these out as you're buying new assets, new equipment, and you're financing them with debt. The no tax and tips on certain overtime and certain tips. Again, focusing on what Aaron and Steve mentioned earlier, certain tips are tax exempt, but this is federal only. So again, federal planning, state planning, and some of these rules will sunset, which you heard earlier. So again, planning for all this is how you get ahead of the game and how you can save money in 26 and 25 and future years. So as we said, there's a lot of detail that goes into this. So you need to kind of understand what the starting dates for these rules are, which ones go retroactive, meaning can I go back to a prior year and open up the prior year and take advantage of those rules? Which ones are permanent for now and which ones are definitely going away? So definitely speak to people that you know in this area, speak to your advisors, speak to your attorneys to see how you can start to save some money. The last thing I'll mention is on our homepage, and when the IFA sends out some of the deck that we have here, there's a link to our firm's homepage. We're constantly updating, all the laws for the tax bills with examples and links for you to read. So you can certainly check that out. And last thing, as I'll mention, thank you to Haider, thank you to the IFA for allowing us to sponsor this. We appreciate, all the time. Thank you to the panel for your, sharing all your knowledge on this tax bill. And hopefully everybody will enjoy the rest of the summer. And a bunch of us will see you at future conferences and events that are coming up through Q4. So thank you, everybody.
Thanks, everyone.